A lot of people swipe a credit card or take out a loan without thinking about what it actually costs. That real cost is mostly hidden in something called APR. Today you'll learn what APR means, how it works, and how it affects your money. APR stands for annual percentage rate. It shows the yearly cost of borrowing money. Think of it as the price tag on a loan. If you borrow money, APR tells you how expensive that borrowing is over 12 months. If a credit card has 18% APR, that doesn't mean it charges 18% once a year. It charges interest month after month, and that interest adds up over the year. Before APR was standardized, lenders used confusing terms and hidden fees. People couldn't compare loans properly. APR fixed that by showing one number that reflects yearly borrowing cost. With APR, comparing loans is easier. If one card has 24% APR and another has 18%, the second one is cheaper over time, assuming everything else is the same. APR isn't always the same as the interest rate. The interest rate is just the basic cost of borrowing. APR includes interest plus certain fees, so it's a more honest number. Example, a $5,000 personal loan with a 10% interest rate and a processing fee might show an APR of around 11.5%. That APR reflects more of the real cost. Different financial products use APR differently. Credit cards often use variable APR, which means the APR changes over time depending on market conditions. Mortgages and auto loans often use fixed APR. That means the APR stays the same throughout the loan. Fixed APR makes planning easier because your cost doesn't change. Some credit cards use promotional APR offers, like 0% APR for 6 to 12 months. During that period, borrowing feels cheap, but once the promo ends, the regular APR kicks in. Some credit cards use promotional APR offers, like 0% APR for 6 to 12 months. During that period, borrowing feels cheap, but once the promo ends, the regular APR kicks in. APR also connects to credit scores. Higher credit scores get lower APRs because lenders trust those borrowers more. Lower scores get higher APRs because lenders want to reduce risk. For example, someone with a 750 credit score might receive a 12% APR offer. Someone with a 580 score might get offered 26% on the same product. That difference in APR directly affects how much buyers pay for the same item. Good credit makes borrowing cheaper. Poor credit makes it expensive. APR also affects mortgages. Even a small difference like going from 5% APR to 5.5% can cost thousands of extra dollars over a 30-year loan. Lenders use APR because it makes everything consistent. Borrowers need APR because it makes comparison fair. It removes guesswork from choosing loans and credit cards. One thing to remember is that APR doesn't always include every fee. Some products still hide costs in other areas, so reading the fine print matters. APR also doesn't account for compounding frequency. Compounding is how often interest gets added to your balance. Daily compounding grows debt faster than monthly compounding. Credit cards usually compound interest daily. Mortgages usually compound monthly. That difference changes how much borrowers actually pay even if the APR looks similar. APR also applies to installment loans, buy now pay later plans, and store financing. Whenever you see payment plans, APR is there, whether it's clearly shown or quietly hidden. When choosing between financial offers, comparing APR is one of the simplest ways to save money. Just choosing a lower APR can save hundreds or even thousands over time. The main goal is to borrow cheap and borrow smart. That starts with understanding how lenders price debt and how APR turns that into a number we can compare. So remember this: lower APR means cheaper borrowing. Higher APR means more interest, faster debt growth, and more money leaving your pocket. Now that you know what APR is, you can compare credit cards, loans, and mortgages with confidence. Understanding APR gives you control over your money and helps you avoid costly mistakes. If you found this helpful, make sure to subscribe for more simple finance guides. We break down credit cards, loans, and investing in a way anyone can understand. Hit like, share it with a friend, and I'll see you in the next one.